What if the war never paused at all? What if the silence was only theater? A so-called 5-day pause was announced, yet missiles continued to fly across the sky. Cities remained on edge, and infrastructure kept burning in the night. One side claimed progress, speaking of talks, of de-escalation, of control. The other side rejected the narrative entirely, insisting there were no negotiations, no compromise, no retreat. Both declared victory with unwavering confidence, yet neither reduced their firepower. This contradiction is not accidental. It is strategic because this is no longer just a battlefield conflict. It is a war of perception, of narrative dominance, of controlling how reality itself is interpreted. Markets reacted instantly to the illusion of calm, surging upward as if danger had passed. But beneath that surface optimism, nothing fundamental had changed. The strikes did not stop, they simply shifted targets. And in that shift lies the truth most people are missing. The so-called pause was never a ceasefire. It was a redirection of force. Energy infrastructure was temporarily spared. Power grids, oil facilities, gas flows, but military targets remained fully exposed, continuing to absorb relentless pressure. This distinction matters more than it appears. Because energy is not just infrastructure, it is leverage. It is economic survival at the same time. Strikes intensified elsewhere, deep into urban centers and strategic zones. Retaliation followed retaliation, each side calibrating force without appearing to escalate too far. This creates a carefully engineered illusion. A war that looks contained but is actively expanding beneath the surface. Meanwhile, critical energy assets across the region have already suffered damage. Not symbolic damage, functional damage. Supply chains are strained, insurance costs are rising, risk is compounding quietly beneath headlines designed to calm the public. This is not stability, it is controlled instability, and it is being managed with precision. You asked about the strikes, about the places hit, and those still at risk. Certain key cities have already felt the impact. Industrial zones, refineries, and logistical hubs have all been targeted in earlier waves. Even when defenses intercept incoming threats, debris still falls, damage still occurs, fear still spreads. The question is no longer whether a location can be hit. The question is how often and how sustained those attacks will become. Energy terminals across the broader region remain vulnerable. Some have already been struck. Others are operating under constant threat. This is not random targeting. It is systematic pressure applied to the arteries of the global economy, because when energy flows are disrupted even slightly, the effects ripple outward. Prices shift, confidence erodes, systems strain. So while headlines focus on individual events, the real story is cumulative damage, a slow tightening of pressure, designed not to break instantly, but to weaken steadily over time. And yet, despite all of this, gold is falling. Silver feels restrained. This seems to defy logic. War should drive safe haven demand. Fear should lift precious metals. But markets do not move on emotion alone. They move on liquidity. In moments of stress, large players sell what they can, not what they want. Gold becomes a source of cash, not just a store of value. Silver, even more so, exists within a structure dominated by paper contracts. Futures markets dictate price far more than physical demand. This creates distortions, temporary but powerful movements that feel manipulated because in many ways they are structurally constrained. At the same time, the dollar strengthens under pressure. Capital seeks safety, not in metal, but in liquidity itself. This suppresses gold further, creating a divergence between expectation and reality. But these conditions do not last forever. They build tension, financial, structural, and psychological. When major financial institutions begin warning about a credit bubble, you should listen carefully. A credit bubble is not just debt, it is excess layered upon excess. Leverage built on assumptions that no longer hold under stress. In times of war, this becomes even more fragile. Governments borrow more, systems stretch further, risks compound silently. To pop such a bubble does not always mean collapse. It can mean controlled release or forced reset. Either way, it implies change. Structural change that reshapes markets, currencies, and power itself. Large institutions do not wait for these shifts. They position ahead of them. They trade volatility in the short term, moving quickly, extracting value from instability. But beneath that activity, they accumulate quietly, real assets, strategic positions, long-term leverage. Because they understand something most do not. Periods like this are not endings, they are transitions. As for sovereign gold, the question is no longer hypothetical. Rising geopolitical risk changes behavior. Trust in external systems begins to erode slowly, then suddenly shipping routes face uncertainty. Regional tensions escalate. Strategic assets become potential liabilities if held abroad. Under these conditions, the logic shifts. Nations begin to reconsider where their wealth truly resides. Repatriation does not always happen publicly. It does not require announcements or confirmation. It happens quietly, through policy, through movement, through preparation. And while there is no definitive signal of large-scale action yet, the pressure is building. because in times like these, control becomes everything. Control of energy, control of narrative, control of assets, and when both sides claim they are winning without hesitation, without doubt, that is often the moment before escalation accelerates. Not resolution, but transformation into something far more consequential. But this raises a deeper question, one that cuts through all the noise. If gold cannot hold its ground in a time like this, then where exactly can you go? For generations, gold has been the ultimate refuge, the asset of last resort, the place capital runs when everything else begins to fracture. And yet now, even as conflict intensifies, even as uncertainty spreads, its behavior feels uncertain, almost restrained. So the question becomes unavoidable. Is there still such a thing as a true safe haven? Cash offers liquidity, but it is tied to systems that can be inflated, restricted, or redefined. Bonds rely on trust in governments, trust that weakens under pressure. Equities promise growth but collapse quickly when stability disappears. Real estate is tangible but immobile, exposed and slow to react. Even commodities fluctuate under forced selling and leverage unwinds. Nothing remains untouched when liquidity tightens. What we are witnessing may not be the failure of gold, but the failure of the concept itself, the idea that safety exists in a single asset, in a single place, in a single system. Perhaps the new reality is more complex, more fragmented, less comforting. Safety is no longer absolute, it is relative dynamic, constantly shifting with power, policy, and perception. And in such a world, survival does not come from finding the perfect refuge. It comes from understanding that no refuge is permanent and positioning accordingly.